Hey guys, Jared Wesley here of Live Traders, and it is that time of the week. It is lecture time. And this week's topic, guys, is focus, focus, focus. We need to focus on our watch list. We need to focus on our favorites list. You need to create a morning gap list, morning watch list, carryover list that you actually use when the market opens. You don't spend from 9 a.m. to 9:30 scanning for ideas just to throw them out the window at 9:32 in the morning. And that is exactly what many of you guys out there are doing. And it's costing you a lot of money. So we're going to talk about two topics there. We're going to talk about focusing on your favorites, even if they gap up and then immediately pull back, or gap down and immediately bounce, you still should not be taking them off your list. And then the other topic we're going to talk about is fighting the lull. You're like, what does that even mean, Jared? You don't want to be a salmon swimming upstream, guys. Okay? You really don't. So many of you out there, you want to be heroes. You know, you got this big monster trading ego, and you want to go against the trend all the time. You're sitting here going, oh, but Jared, Tesla's up 7 days in a row, or Nvidia's up 7 days in a row, or Futu's up 8 days in a row. It has to pull back. No, it doesn't. It doesn't have to pull back. Just because you think it should pull back doesn't mean it will pull back. Look at the markets we're in. They're the stupidest, craziest markets I've ever seen in my life. It's like the Fed doesn't stop the printing press. They just keep it on go, 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 go all the time. Well, stocks are doing crazy things too. So my point simply is, unless it gives you a technical reason, huge volume, topping tail, wide range, blow off top, or whatever, don't short it. Okay, so we're going to talk a lot about that today as well. You guys got to check your ego at the door, man. It's about making money, not about being right with regard to your ego. All right, so if you guys like these videos, please click that like button, smash, hammer that subscribe button. Let's get to it. This week's lecture topic is focus on your favorites. This is a topic that I've discussed a little bit in the past. It's actually a twofold lecture today. We're going to talk about trying to be a hero and picking tops and bottoms. And we're also going to talk about how important it is to focus on your favorites. We spend all of this time in the pre-market, and that time is spent developing our modus operandi, developing our routine of what we're going to do for game time. It's kind of like practice, right? You practice, practice, practice. Game time starts. It's like, all right, we've stretched, we've passed, we've jogged, we've warmed up, we're ready to go. We've trained. That's what your pre-market is all about. And yet I'm seeing people spend 20, 30, 40 minutes, sometimes an hour in the pre-market, and then at 9:32 or 9:33, just dumping a stock off. Just literally, that's junk now. It's garbage. And then an hour later, or at the end of the day, they look back and are like, man, how come I didn't see that stock? And then you realize, oh, shoot, it was on my list, but I took it off, or I ignored it because it didn't do exactly what I wanted it to do in the first 12 seconds of the day. Okay, so we're going to talk a bit about that. And we're also going to talk about, just check your ego at the door. I mean, just check it at the door. You don't have to be a hero and short the high and tell all your family and friends how great you are. Hey, I shorted Tesla at the very, very top. It's a bunch of BS, because doing so is usually detrimental to your trading account. Okay, so we're going to talk about that as well. But before we do that, first, we must talk about when will the insanity stop? Compared to the last couple that we've had, this one is less egregious, but still egregious nonetheless, if that makes sense. So again, it's not as crazy as some of the ones in the past, but the idea of it's as crazy as anything we've seen. So without further ado, here we go. Plants and stonks. Yeah, we know what those plants are for you, buddy. All right. LOTZ, man. Any original folders left? Or original holders left? Never thought I'd be the guy bag holding this badly. I have news for you, plants and stonks. Maybe pull out the bong, okay? No one ever thinks they're going to be a bag holder. If they knew they were going to be a bag holder, they wouldn't be a bag holder. Duh. Jared, you're so mean. No, I'm just not stupid, okay? No one ever believes or thinks They're going to be that person. Never thought I'd be the guy back. Yeah, you probably didn't think a lot of other things either, okay? So my point simply is, I don't know exactly when this particular person is in this stock or what price they are, but I think we can see by the weekly chart of this particular stock, it's not going very well, all right? It peaked around 13 and now it's at $3.65. And, you know, his friend, because misery loves company down here, is still here with a 768 average. Wow, that's only, a 50% pullback. Perhaps this other person at the top, is in at $10 or $11. I have no idea. You don't ever want to be in this position. Not only is it terrible for your bank account, trading account, right? It's terrible for your psychology in terms of this person, depending on how much money is invested in this stock, is probably living a miserable life right now. No, I'm not trying to be mean. They're probably living a miserable existence, especially if this accounts for the vast majority of their savings. Imagine if you had 50 grand and you're down 45,000 of it or 40,000 of it, and you have to sit here and watch a lots, okay, which goes down lots, okay, and you're sitting there going, what am I going to do now? You don't ever want to be in that position. So don't put yourself in it. All right? You're going to be stressed out. You're going to be depressed. You might do silly, stupid things to yourself, and that's not cool. So money management rules everything. All right? Money management rules everything. All right. Let's move along. We don't have time for this kind of insanity this week. It just says focus. No excuses. Just focus. It's an easier thing to say than it is to do, because I think we have, as traders, we have good intention, but the market has a funny way of messing up our good intention, if that makes sense. All right, and we need to find a way to push that little devil on our shoulders off our shoulder and just listen to the angel. All right. So one of the things we want to talk about, and just as an FYI, I know many of you will like this aspect. This is the only text slide of the entire lecture. Okay, focus, that one word, it's the only text slide. There's one quote I put in here, but I don't really call that a text slide. Everything is charts today, 100% charts. Okay, so let's dig in and take a look at some of those charts. All right, so here's an example, all right, of a stock that gapped up, left the bottoming tail, and immediately pulled back. Bounced, pulled back, bounced, and then eventually around 946 rips, right? So gaps up and immediately fails. Take it off your list. Now, for some of you, you're like, well, no, I wouldn't take it off my list. But many of you would, or better yet, worse yet, however you want to look at it, you focus on something else. So perhaps you leave it on your list, but you've downgraded it so far, you barely watch it anymore. Right? So this is a prime example of a stock that just, and it's not even that long, it's a 1 minute chart where it struggles, right? It just struggles off the open for whatever reason, but then starts to shape itself up by putting in higher lows. It held support, it stays above the moving average, and then consolidates back towards the moving average, okay? And 333 in this case would be the entry. Could you take an aggressive entry at 332 by 330? Perhaps. It was a little bit aggressive, but maybe. All right, and over here you get in at 333 and your stop loss is 332.25. And then you ride it out and it ends up going $3.50 on what was a 75-cent stop loss. So you could have got at least 4-to-1 out of this thing, all right, before the bottom fell out and it went lower. But this is a prime example of a stock that you're jonesing to trade, and then it puts in 3 big red bars and you're like, the heck with that thing. I'm not trading that anymore. And what would have happened later, it would have given you 1, maybe 2 opportunities to trade it, and that's money lost. Money you could have had in your account, but you don't now because, well, it wasn't doing exactly what you wanted it to do 2 seconds into the trading day. All right, here's another example. All right, this one I see a lot from folks. Here's a stock that gaps up and honestly looks pretty good, right? Puts in a bottoming tail right here. Puts in a narrow range resting bar. And what do we have? We have an intended 5-minute 3-bar play. I mean, that's what we're all looking at. Wide bar, narrow bar, and you're thinking, all right, I'm putting my order and rip. And even when you see this bottoming tail, you're like, okay. And then it breaks the low of the day, and you're like, screw this stock. The heck with this thing, right? Despite stalking this pre-market, due to the excellent gap and the nice pre-market chart, we weren't able to get a quality entry until later. Lesson, if a stock has a nice gap, do not take it off your list. Be patient. Not every trade triggers exactly where we want it. That last part is key. Sure, in the pre-market, we have intended entries. We have ideal entries. We have areas of interest. But we don't always get those ideal entries, or we don't always get it at that perfect area of interest. Does that mean for the rest of the day this stock is destined for terribleness? No, there still might be some greatness left in the stock. It just isn't happening right now. It could happen later. Not everything has to happen in the first 10, 15 minutes of the day. Sometimes stocks just, they don't do what we expect, but later on they do. So in this particular case, you could have had an entry on the pullback here. Now, is this the world's cleanest, most amazing buy setup? No, but it is a 50% retracement from the top here to the bottom here, maybe a little bit less. It's above the moving average and has a pretty good size green engulfing bar. It's about an 80% engulfing bar after it left the bottoming tail. So at one point in time, this was a red bar. It was a wide range red bar, followed by a smaller red bar that got into a fight with buyers, and the buyers slapped the sellers silly and completely engulfed the red bar to the left, 80%. 127.50, you put your stop at like 126.25, it's a $1.25 stop, and this thing goes to 132.50, give or take. It goes $5 on a $1.25 stop. Could have got another 4 to 1 out of it. Now, you could have, if you were a little bit more nervous, you could have taken a partial lot here and then added back on this little breakout pseudo, I call it pseudo 3-bar play because we don't generally like to take them out of these types of buy setups, but you could have added over here. But how annoying would that be if you saw this as a really nice gap, you saw the 5-minute 3-bar play, and then you're just like, the heck with this thing, I'm done with it. And then later on it gets to target. People are doing this all the time, every day. Here's another example. Start with the daily chart. We have a nice gap up. Note, the line in the sand is somewhere around $19.75, which is this big red bar. Okay, that's the resistance point. There's a topping tail there. There's a topping tail there. We're gapping above that topping tail. What happens? Well, it gaps up and gives you 1, 2, 3, 4, 5, 6 bar consolidation. I mean, you're sweating this one. You're jonesing. Like, you're going, oh my gosh, it's the finest thing I've ever seen. I want to get in at 20. My stop's 1980. Maybe even it's the low of the day at 1970. But I have to get me some of this bad boy. It pops up, probably 20 cents. Okay, goes about 1R and then just slaps you silly. Drop, 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 drop. So you have two choices here. You could buy this pretty large pullback to the rising moving average because that pullback also happens to be where this red line is. See the red line on the daily? That pullback is in the same area, okay? But admittedly, it's a pretty steep retracement, right? The angle of retracement here is pretty steep and doesn't necessarily evoke huge amounts of confidence, okay? But you had a failed breakout. But the pullback is too, remember, the ceiling becomes the floor. So this was a double top ceiling, but the double top ceiling now becomes a floor. This is the bottom, okay? It goes a little bit below that. You can see that by the bottoming tail. Goes a little below it and starts to bounce. So again, you get in at 1950 with a stop at 1920, ride it back up, or you can 84% it. You get in over here, and then you just 84% it back here, and then the stock eventually goes about 70 cents on a 20-cent stop loss, 2.5 to 1. All right, but when you look at that daily chart and you see that gap, you're thinking, why would I take it off my list just because a breakout 7 minutes into the day failed? Is it doomed for the rest of the day because it didn't do the right thing on a breakout, and because it stopped you out, you're pissed off at the stock, and now because of that emotional deficit, you're gonna miss the next entry? It goes back to focus, and again, we're seeing people do this, you know, very, very, very frequently. Right? Very frequently. Let's see. We need to start right after that second entry. I don't know. It really depends, right? It really depends how this triggered. Did it trigger after it pulled back and then click back up? And then it looks to me like that holds right there. I mean, we could try to put a line on it and see what happens, right? We take the bottom of that right there and pull this across. So that obviously holds, right? That holds the stop loss. We'll even move it down a little bit. But the question is, how does it trigger, right? That's knowing the chart. Does it trigger before or after the shake, right? So anyway, the point is this held and went higher. You could have nibbled some down here. Again, most of the time this would be a tough pullback to buy, but when you look at the daily, you're like, it's in the right spot. It's still at the moving average. Maybe. I'm not saying you should buy it here at 1950, but you could certainly have a conversation about it. Okay? So take your stop, move on, take your 84% play, make money. All right? Here's another example. We take a stock on the daily. All right, it's gapping from a bit of a green bar, but it's still a nice gap because you're taking out a double top right here, pivot here at 36. You're also taking out 2 to 3 red bars to the left, and you have void back to this area of roughly $40, roughly, okay? And there's a red line there. So the green is the support because you're gapping above it now. So it used to be red, but now it's green because you're over it. And then this is the area that we're looking for a target on. So anyway, stock gaps up, opens on the 2-minute time frame. This is, it gets choppy, right? It does. It gets a little choppy, but it does give you a 4-bar play. This is a wide range bar followed by 2 narrow range bars with relatively equal highs because they don't break the high of the day. So 37.80 is that initial entry. Your stop loss is 37.40. That's the initial entry. All right. If you happen to miss it, though, which it's possible, maybe you weren't looking, maybe it was too sloppy for you, whatever, there's another breakout over here at $39, okay, with a stop at roughly $38.50, maybe a little higher than that, all right? So could we have made an argument that a $2 move, $2.50 move from 36.70, whatever that is, all the way up to 39 is a little bit too much to take this breakout at 39? You could. Right? You'd probably add in that position. The stock has certainly done $2 and $3 days in the past, over here, and maybe over here. But you could make an argument to hold off of the $39 breakout. But stock like this showing this much strength, maybe it's worth it. Now, over here, you see this pullback? This is tough because now you've had a stock that's moved up $3.50 to $4. Right? You look at it right there and you're like, I don't know if I would add here. Why? Because we're at resistance, right? We just peekabooed above resistance in an extended manner, right? $40 was the target. You can see the red line. Would I buy the pullback? If you did choose to buy the pullback, you'd have to look at the high of the day as your hard target. So if you could add here and then maybe, you know, get back to 40 to 40.50, that might be okay, but this is a tough add. Okay, the question is, pivot on daily is also very close for the $39 breakout. You could make that argument, but $1 away is $1 away, and this is a very smooth pullback. Right? There's no real hiccups in that $39 area when you look at it. It's a clean cut, so to speak. So I understand what you're saying, but you could certainly argue, you could make some reasons not to take this at $39. You know, if you're in at $37.80 with a 40-cent stop and by this point you're already up $1.20, it's 3 to 1. Yeah, you might say, you know, I'm not going to add. But if you were trailing out, you would raise your stop here and then raise your stop here. And honestly, you wouldn't stop out until later in the day when you see the topping tail. My point on this one, though, is it's worth looking at $39. And just because a chart got sloppy off the open, like a doji bar off the open, really whippy and wild, doesn't mean it won't materialize later. You spend a long time on these gaps, guys, a long time. Don't throw them off your list. Don't throw them out of your house because of one indiscretion, so to speak. Here's another example of this, right? You're looking at a stock that's gapping up over a red bar, a doji bar, a red bar, and a pivot at $50. Okay, so it gaps up, and you can see that right here. As soon as it gaps up, it just rips, straight up rips. Like it goes from 50.25, 50.30, whatever that area is, all the way. I don't know why that stop says 50.25. That stop should say 55. Okay, my apologies for that. All right. Anyway, so the stock rips, and you're like, done. Done. Gaps up. It had this beautiful gap. I can't believe it's moving like this. It's done. I'm not going to trade it today. And then what happens? It has this nice, smooth, sequential pullback with lower highs and lower lows and bottoming tails. leaves a bottoming tail here. It's above the moving average, and you get an entry at 50.75 with a 20-cent stop loss. This thing moves back up, pulls back, and then goes higher. It ends over $52. You're sitting there like, man, that's $1.25 on a 20-cent stop loss. In fact, it's probably more like a 15-cent stop loss, but that's besides the point. Just because it ripped up in the first 6 minutes of the day doesn't mean it won't give you an entry later on. All right? And I'm seeing this a lot from people, and getting emails a lot from people where they're like, yeah, I missed the initial move, so I took it off my list, or it just wasn't worth it, or I was too scared to get back in. Now, obviously, if the initial pop was, 5 times average trading range, maybe that would be a different conversation. But you have a stock here that was about average trading range, right, on that first pop. And then the pullback was pretty nice. You could have traded it just back to the prior high, which is like 51.40, right? So a lot of times these later entries are going to be a little safer, a little more secure. And obviously, if you can use the market and take a look, does it have strength, does it have weakness to the market, it'll be a little bit easier, okay? Yeah, Deviator, these are some of the better trades that you can take, right? Now, on the flip side of this, and I'm only going to use one example today. On the flip side, we just talked about being patient, right? And waiting for a different entry. Or if we missed an ideal entry, don't just throw it off the list, kick it out of the house, give it time. Well, now we're going to do the opposite, right? Now we're going to pull back and we're going to say, all right, well, what if we get a stock that has a nice pre-market chart and a nice gap? How about that? Can we be more aggressive with something like that? And the answer is yes. And unfortunately, I don't have the daily chart on here. I should have put it on. I apologize for that. But the point simply here is if we look on the left, this is a 5-minute stock without the pre-market chart. So this is a stock that gapped up over a pivot, and it went from like $26.70 all the way to $29. That's a stout move. That's a 20% move. Or sorry, 10% move. That's a 10% move, okay? And maybe you could have argued to take this at $27.50 right there, maybe, okay? Now we have a bit of an issue. Do we want to take the buy setup over here because this was such a big move? That's a challenge because, again, it just moved up 10%. We'd have to look at the average trading range and see how the stock is trading. But what if we saw this gap and go, wow, this is a level 1 gap or a level 2 plus gap, and we really, really like the gap, and we see something like this in the pre-market? Why not nibble some? In this particular case, you don't actually have to nibble some until the market opens. So what I'm telling you here, guys, is with a quality gap, we can take some shares in the pre-market or as the market opens. In this case, it actually doesn't break above 27 until after the market opens, right? You can see that right here by 9:30 at the bottom with the volume spike. I should have put a little arrow to it, but you can see it actually triggers right here, all right? So you could have actually waited, bought it at 27, put your stop at 26.50, and boom, you have a 4-to-1 move in 20-30 minutes. Maybe you could have added at 27.56. The point I'm making, though, is if the gap is good enough, it allows us to be more aggressive. If the pre-market chart is also good with the gap. Does that make sense? We're still not just going to say, oh, great gap, I'm jumping in immediately. No, we're looking at this and we're saying, okay, great gap and great pre-market chart. When the market opens, I'm going to put an order at $27 and I'm going to give it some room. Okay? So when you look at it like that, I think this is a reasonable entry. Yes, of course it's going to be spready and whippy. It's the market open. It's 9:30. It's 9:31. But you can justify this entry because the pre-market was so good with a good gap. Okay? Which is, in my opinion, a better entry than this pullback at 27.50 over here. Okay, so again, that's a pretty steep pullback. It's a wide bar. It probably bounces, but probably does not put in a new high. I'll repeat, this buy setup probably bounces, but probably doesn't put in a new high. So if you wanted to take that with like a 15, 20 cent stop and try to trade it back up for a quick scalp, 1, 2, 3R, something like that in this particular, maybe, but this is the best entry on the chart. All right, so I'm not going to get into pre-market charts as much today, but I'm making the case for the opposite. So if you have a great gap and it doesn't give you a great pre-market and just rips off the open, don't take it off your list. Try to get a later entry. If you have a great gap with a great pre-market, you can be much more aggressive off the open because you're not just taking a 2-second high, you're actually taking a pre-market breakout. There's actually a pattern there. And again, if it's a nice gap, it will also have great volume in the pre-market as well. This is basically the last tech slide of the day. Consistency is better than rare moments of greatness. I saw this quote and it kind of hit me and I thought, wow, doesn't this really encompass so many traders? Be honest about it. You guys have a great week, a great month, you're flying high in the sky, but you have no consistency. Your reversion to the mean is back to consistently losing, all right? So think about it. Consistency is better than rare moments of great. I would rather have you guys consistently make 5 or 10 R a month than 1 month make 20 and then lose 5 R for the next 4 months in a row. And this is what happens to so many traders. They just sit there and they have one good flash of brilliance for a week or a month. They think their shit doesn't stink and then they go back to losing again. And then they think somehow that that flash of brilliance was skill rather than luck, and they think them losing is unlucky rather than unskillful. It's very fascinating, the human psychology. Okay? All right. Now, I want to talk about a couple other things. Before we do that, though, I have a couple more slides on focus. This is a great example, and this is on a, I believe it's a weekly chart, okay? Weekly chart. So you know why I say everything is valid in all time frames? Well, this is a great example of that. So what we have here is a stock that honestly is not that great. It's just chopping around, right? It's in an uptrend. We can see that from the blue moving average here. It's in an uptrend, but it's pretty sloppy all over the place. Finally, out of nowhere, and it is truly out of nowhere, from $32, you see this massive wide range green bar. It comes out and it takes out everything. I don't know what the news was. I don't care. But it takes out everything. And then it moves up and it moves up. Now, what a lot of novice traders would think is, oh, shit, I missed the move. I missed the move. Well, one, you weren't supposed to catch this first move. It came out of nowhere, came out of left field. Like, what the heck just happened? You weren't supposed to catch it. This is a stock that really would not have been on your watch list. Look where it was trading. Down here at $33, which was a real crappy area to be trading. And if it wasn't on your list, I wouldn't expect it to be. So it goes up once, 1 bar, 2 bars, 3 bars, 4. The first thing you should be thinking here, as soon as you see this wide range bar, talk to me. Forget about the future. As soon as you see this wide range bar, there are 2 things you should be thinking. What are those 2 things? There are 2 things you should be thinking. Right after you see the wide range bar form and break this prior pivot. 2 things. One of 2 things. You should be saying to yourself, consolidation or pullback. Exactly right, Nick. Those are the exact 2 things you should be saying to yourself, okay, now that we have broken resistance, I would like to see either a multi-day consolidation, resting period, in this particular case, multi-week resting period, or I'd like to see it go a little bit higher and then pull back to support. All right, I don't want to see it pull back from here at $44 or $42. I don't want to see it pull back from here. Why? Because if it pulls back from here, it pulls back below the resistance point. I want the resistance point to be the new support area. Let me repeat it, pay attention. I want the resistance point on the left in the future to be the new support area. Hence, the red line turns to a green line. So when I see this bar, I either want to see it go a few more weeks higher, then pull back to support, or go sideways for a few more weeks and then rip. Those are the 2 things you should immediately be thinking. So this stock should now be on your universe list, on your watch list, okay? And what does it do? 3 more weeks up, pulls back, Peekaboos below that area of support, but it's still in a very nice spot above the moving average. You get a nice green engulfing bar, and here's your entry. 43.25, 41.50, rip. And this thing takes a while because it's a weekly chart. It almost shakes out right here. And what happens? It goes all the way to $51 or $52. It goes like $7 or $8 on a, I don't know, $1.75 stop loss. You get 4 to 1, 5 to 1 out of your money. Okay? So this is exactly what you wanted to see happen or have happen. And it happened. But if you didn't think it on this wide range bar, you would have never waited for it. See where I'm going with this? With the focus and the patience and the discipline? If you just saw a wide range bar, you'd be like, there's nothing I can do with that bar. Well, now you know what you should be thinking in the future. All right? Now, let's talk about something a little bit different. Ego's a terrible thing, right? It really is. Gets you in a lot of trouble in a lot of different ways in this world. In trading, gets you in a lot of trouble. Well, we're going to talk a little bit for a couple minutes on, well, maybe not needing to be right all the time and needing to be the first person in. You have those pub bragging rights with all your friends. So we're going to take a look at these pink lines here. Why? They correspond to all these volume spikes. All right? Most of them, not all of them, most of them. Okay? Ego is greed. Greed is ego. They're the same thing. How do you be greedy without having an ego? They're one and the same, right? So anyway, this was a nice gap up right over here, right? Gapped over a red bar and over a pivot. Big volume spike. You would expect this to be igniting volume, and in some ways it was. But this thing rolled over, so this would be one of those gaps that you scratch your head on. This is one of those gaps where you go, not everything works, guys. It gapped over a red bar and gapped over a pivot. Not everything works, okay? Over here, we just have a massive volume spike out of nowhere. You would not expect this level of volume in the middle of a consolidation before a breakout, right? So this one is very curious. This one, same. Big volume spike over here. What's the point? Sometimes you get randomness in trading, right? We're not trying to trade randomness. We're trying to trade the patterns that are meaningful to us and let go of the randomness. But there are times when they are not random, and we'll take a look at that over here. Okay, so over here, this first one, not random. We expected igniting volume and a huge move up. It didn't happen. Oh well. This is a bit random. This is a bit random. Nothing I can do with that. It's not going to hurt me because I'm not going to trade it either. Over here, though, you get a gap up on the biggest volume on the chart. 18 million shares on a stock that's averaging like 5 million. 3 or 4 times volume after an extended move up. What happens? Stock pulls back. Over here, you get igniting volume, which is what we should have seen over here. Okay, stock moves up a couple days, pulls back. Now, let's focus on this recently. Why am I putting this chart up here? Well, because this is something we've been talking about and people have been trying to trade recently. Okay, 1, 2, 3, 4 days up, gap up. You guys want to be the first person to short this thing. For some strange reason, you guys have an ego the size of a freaking sequoia tree, and you want to be the first person to say that CRM has to pull back. Well, why? Because I think it's extended. Why? Because it's up 4 days. And it can't go up 5 or 6. We've never seen in our lifetime a stock go up 6 days in a row. Well, we have, Jared, but it's extended. And what is telling us this? Is there a blow off top? Is there some tremendous volume spike? Note, you don't see a pink line over here, do you? Well, there's no massive, crazy institutional volume. There's no wide range, super wide range bar. It's far from the moving average, but it's not ridiculously far. Why do you want to be first? So what do? Short it? This is what CRM looked like 2 days ago. Bounced off the open, retested a low and bounced. Okay? What are you doing? Blow off top? I don't think so. Extreme volume? I don't think so. Not comparatively speaking, right? Here, 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 and here. There were 6 or 7 examples of extreme volume. This isn't one of them. This isn't some crazy wide range bar like over here, perhaps. And you want to be the first person to short it. It will pull back eventually. We know this. But let it prove itself to you. Let the stock, look, you don't have to get it on the first day of the pullback. All right. Now, every once in a while, like something like Ulta, it may just pull back huge. But why do you want to short that? Just because it broke the previous day's low? It's not that extended. It's really not that extended. Okay. And just because it broke the previous day's low, I mean, you could be the first person off the boat. I don't want to be. Here we go. Remember this one? You guys remember this one, don't you? Come on. Smile with me. All right? Huge, massive volume. That's what we would have expected when you see igniting volume. Wide range, okay? Couple more green bars, chops around. Wide range, that's a gap up that failed, right? Wide range, fascinatingly enough, set the low here. Granted, it peekabooed lower, but 1, 2, 3, 4 days down, this volume was more like ending volume, right? Because it pretty much set the low. Right here is igniting volume on the way back up. And then the stock goes up and up and up and up and up. I guess, Upwork is a good name. I think that's what it's called. Anyway, pulls back, goes up. Now, I ask you guys a question. How many times on this move up would you have done really well shorting this stock? Maybe over here for a few days, and then it pivoted and just ripped again. So again, I understand it's a little bit extended. It is, but it's been extended for weeks, for months. And what's happened? Every pullback has been bought up. If you're lucky enough to even get a pullback, it's been bought up. But we got to be the first people in, don't we? We just have to be the first person in, don't we? And this is what happens to those people. They get beaten on. This stock isn't ready. It's not ready. And guess what? Every once in a while, a stock will just tank out of nowhere. And you go, oh, I should have shorted that. No, you shouldn't have. The risk was insane. It was too risky. This is way too strong of a stock in too strong of a market to want to short this thing. Okay? Don't do it. Don't do it unless you get a mega gap up with a huge blow off top on the biggest volume you have ever seen. If you don't see those things, just wait. Okay? Just wait. You don't need to be first. That's just your ego. Why do you want to be first? Well, we know why. If UPST does pull back, it's probably going $100. Well, I want to be in that. I want to be in that with a $3 or $4 stop loss. I want to make 20 to 1. I get it. But you're going to lose a lot more money trying than getting. And you can see that on the way up. This was tough, and it still is tough. I don't know what it's doing today, but it's probably higher. Okay? I don't know about you guys. I wasn't there, and I'm very thankful that I wasn't, and I have a lot of respect for the people that were. But I'll tell you this, man. When that gate opens in the front there, right? When that ramp goes down, guess what's behind it? They're not Nerf bullets. They're real bullets. Okay? And in your life, that means money, dollars. It's not fake dollars. They're real dollars. Okay? So I don't want to be the first person off the boat on D-Day. All right? There's a lot of pain right there. I want to be the reinforcements that come later. Why? Because if we're right, if we're right, the stock's going to go a lot lower. Okay? And yes, it's sad, but absolute respect to these people, right? So in trading terms, guys, it's very, very expensive, the need to be right. to be first is a very expensive emotion. All right. Once in a while, to your detriment, you will be right. And when you're going, what do you mean to my detriment? The few times you are right keeps you coming back for more. I'll repeat it. The few times you are right, when you're first and you're right, keeps you coming back for more. All right. And it can be very, very, very expensive. All right. So what's the lesson here? It's hard to short the strongest stocks in the market at any time, let alone a 10-year bullish market where the Fed never shuts off the printers. This is Tesla. Shorting Tesla, yeah, here you go. It took 6 weeks to finally roll over. When it did, it dropped $300. My point, there's your blow off top. There's your volume, and it wasn't even the biggest. And it still took 1, 2, 3, 4, 5, 6 weeks before Tesla actually gave it up. Okay? Think about that. Even though we got the bar we wanted, the wide range ending bar with volume, it still took 6 weeks to break the support at $800. That's how strong these stocks are. They are not going to give it up easy. All right? It's that Victoria's Secret model. It's not giving it up easy unless you're a billionaire. Okay? Chop, 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 drop. Finally, and then it double bottoms and it's all the way back up. There's a reason these stocks are strong. There's a lot of institutional interest in them, and they don't want to see their investments go to crap. All right? You think BlackRock is going to let these stocks fail? You think Vanguard? You think State Street? You think these companies are going to let these stocks fail? I don't think so. 20 trillion under management. And you need to be first, though. Right? I wouldn't want to be. Now, on the flip side, you can take these sometimes when the stars line up, when everything comes together, right? So extreme move lower for this stock, and that's key for this stock. No need to be the first person in. Let the green bar with the bottoming tail on volume far from the moving average be your guide. What's the point? I don't need to buy the bottoming tail. The bottoming tail is my sign that buyers are stepping back up after multi-bar move low. And again, normally this would not be a climactic move for any other stock, but for Verizon, it is. This is a massive move for Verizon, big move. Drops, huge ending volume right there, right? Massive ending volume. Big time volume on the bottoming tail, doji bar, narrow body bar, change of color bar, huge volume, far from the moving average. Oh, next day, get the entry right there. And it's back up again today. What's it, like 53.50? Something like that today on Verizon? 53.70 it's sitting at right now. What if you bought that right down there? You're looking good. You're getting your target. 54 is your target. That is letting the chart come to you. That is not your ego telling you what to do. This is the chart coming to you. Why? Because we have multiple concepts converging in an area. It was a reasonable trade. Okay? So, I hope you guys learned a little bit about focus, focus, focus. Not giving up on stocks just because the first 5 minutes of the day don't do exactly what you want. I hope you also learned a little bit about maybe using some pre-market charts to edge your way into an early trade or buy an early trade at 9:30, 9:31. And most importantly, at the end, I hope you guys learned a little bit about not needing to be the first person in a trade. Okay? Because it can be a very expensive lesson to learn. All right, I'm Jared Wesley of Live Traders. We'll get back at it again next week.